There are 5 different types of volume imbalances in price that I teach to my students, and today we're going to talk about gap imbalances. Most of you should already be familiar with normal volume imbalances, where we are having a notable difference between the closing price of a candle and the opening price of the following candle. You can find them in every market, whether you want to trade indices, cryptocurrencies, bonds, commodities, or any other asset. Just remember to always use the futures charts of an asset, as you will not find them in the spot market, as I've mentioned in an earlier video. They occur when the price jumps sharply from one level to a higher or lower level without any trades in between. These imbalances are very important for future price action, as they have a magnetic functionality for price and will therefore always be revisited by price at some point and can help you with trading decisions. Now, talking about gap imbalances, we differentiate between those from the market closing price on one trading day to its market opening price on the next trading day, and also the intraday gap imbalances, which are very significant for day trading strategies like the DR/IDR. A gap imbalance refers to the price difference between the closing price of one candle and the opening price of the following candle. This gap can occur due to after-hours trading, significant news releases, or other market events that affect the perception of the asset's value. Traders may use gap imbalances to set up trades based on the expected continuation or reversal of the price movement. The algorithms remember those levels and they play an important role for future price action, as they will at some point always be rebalanced. Understanding gap imbalances helps traders make more informed decisions about entry and exit points, potential future price movements, and so on. Let's begin with gap imbalances, which are being created from market close on one trading day to the market opening on the next trading day. These gap imbalances can occur when the market is closing at 5 p.m. on one trading day and opening at 6 p.m. on the next trading day with a notable price difference. I am referring to New York local time, as my charts are always set to this time zone. If the market's closing price at 5 p.m. from one trading day is lower than the opening price from the candle at 6 p.m. on the next trading day, we have a gap imbalance at market open to the upside. This gap imbalance between market close and market open is important for future price action throughout the day and the following days as well. It is highly recommended to mark them out on your chart. The same rule applies to gap imbalances being created between market close to market open to the downside. There, the closing price at 5 p.m. on one day is higher than the opening price at 6 p.m. on the next day. The same rule applies to the gap imbalance created from the Friday's closing price to the Sunday's opening price. If the market's closing price on Friday at 5 p.m. from one trading week is lower than the opening price from Sunday at 6 p.m. on the next trading week, we have a weekly gap imbalance to the upside. If the market's closing price on Friday at 5 p.m. from one trading week is higher than the opening price from Sunday at 6 p.m. on the next trading week, we have a weekly gap imbalance to the downside. This gap imbalance is important for future price action throughout the week. Now we're coming to the more important one, especially when it comes to intraday trading, which is what I define as the intraday gap imbalance. Visually, there is a small difference, but a huge one when it comes to future price action. We have a notable difference, or a so-called gap, between the closing price of a candle and the opening price of the following candle. Intraday gap imbalances to the upside occur when a candle's closing price is equal to its high and the opening price of the following candle is higher than that. The wick low of the second candle is not of any importance. It can fill the gap completely or just by half, it doesn't make a difference. It's more important that the closing price of the first candle is equal to its high. The intraday gap imbalance can act as a restricted area for future price action throughout the trading day and the following days. The same rule applies, of course, to intraday gap imbalances to the downside. The algorithms remember those levels and they play an important role for future price action. Let me show you how to find and highlight gap imbalances on your chart. Before I continue, I would really appreciate some feedback. Leave a like or a comment and let me know if you enjoy these kind of videos and want more. First of all, make sure to enable the open, high, low and close values in your settings in TradingView. With this, you will be able to see the open, high, low and close value of each candle once you put your cursor over it. I have an indicator that lets me enable or disable all relevant imbalances by one click and is accessible to all my students. If you don't have access to that, no worries. There's a way around. For market close to market open gap imbalances, you simply compare. If there is a notable price difference between the 5 p.m. candle, which in TradingView is the 4:55 p.m. candle, and the opening price of the following day's open at 6 p.m., and highlight that with the rectangle tool. Make sure you extend the rectangle to the right for future price action observations. Apply the same to weekly gap imbalances, where you compare the closing price on Friday at 5 p.m. to the opening price on Sunday at 6 p.m. and highlight it with the rectangle tool as well. Now with the intraday gap imbalances, once there is a notable price difference or a gap between two candles, you check if the first candle's closing price is equal to the candle's high or low, depending on if it's a gap imbalance to the upside or downside, and highlight that as well. You can also organize them in your object tree, making it easier for you to enable or disable your gap imbalances whenever needed. Here's a beautiful trade example with just the ones I highlighted from the weekly and daily open, and those that were created right before the ADR session started, and also inside the ADR session. Extended to the right, you can see that they were broken in the RDR box forming and became supportive. Price then confirmed longs for the regular defining range session with a higher probability and retraced back into the range, rejecting the closing price of the RDR session combined with gap imbalances. Combined with volume imbalances makes the picture even clearer. That's a high probability setup where you could easily risk 1R to potentially get 3R or even more, targeting the next SD level. Join me as I teach thousands of students how to trade like a professional. Learn how to trade the DR trading strategy combined with data, get access to exclusive tools and indicators, weekly live trading sessions where you also get deep market insights, which have never been taught in the retail space before, and a lot more. Visit M7DR.com for more information. First of all, you have a great new tool in your trading arsenal, especially when it comes to the intraday gap imbalances. Now, before you utilize this new knowledge and apply it to your trading, it is very important to backtest and understand gap imbalances. Since I am not a big fan of spoon-feeding everything, I want you to go into your charts and study them on your own, as it is also part of my academy, especially when it comes to the intraday gap imbalances. Here are a few things that I can give you to study on your own. Study weekly and daily gap imbalances throughout the week and following weeks. Study intraday gap imbalances. Study those that are being created during and around the after-session defining range or short ADR. Study how price reacts to them when they hold throughout the day and when they get broken. Are they acting as a restricted area for DR models to be intact, for example? Study intraday gap imbalances being created right before a DR session starts. Study them in line with DR confirmations to either side and the retracements after. Can you improve your entry, exit, and stop loss levels with them? As you can see, the list is endless. I guarantee that you will be surprised at how beautiful those gap imbalances are. Studying them on your own will be much more beneficial for your journey as a trader. Good trading results require hard work. Don't forget to use M7 Metrics, a platform developed by my team to do your backtesting and journaling, which is completely free. You can find all links in the video description below. I hope you learned something new and see you in the next videos.
We're gonna take on the world.